Yesterday we had 33 slides to get through in 15 minutes. Today we have 28 slides to get through in 45 minutes. So we've got plenty of time to talk. We can take questions throughout. If you need to ask questions throughout, that's fine, but I think we'll open it up at the end for 10 or 15 minutes for questions. But if anything is really nagging you as we go through this, please feel free to raise your hand and we'll get this done if you remember that from school days. What was it, Morehouse? Muhlenberg, there you go. So we're moving into an midterm election year. There is one gentleman in here that has a sense of what that could mean. Anyone else have an idea what happens in midterm election years in the stock market generally? All right, yeah. That's right, good. You will get the free virtual prize. It's so virtual, you're not even going to be able to see it. A little bit about my background. Not everyone was here yesterday or saw me in the morning. Great Hill Capital is my firm. We manage money for high net worth individuals, for family offices, and for institutions. Prior to that, I was at a firm called Cornwall Capital Management. Any of you see The Big Short, the movie? I worked for the gentleman played by Brad Pitt. His name was Ben Rickett in the movie, Ben Hockett in real life. Probably 4 times as smart as Brad Pitt and 1/4 as handsome in real life. But super guy, I still talk to him to this day. I learned a lot about derivatives at Cornwall. They were great and super guys. Prior to that, I was at a firm called Bedford Oak Advisors. The principal was friends with Warren Buffett for 40 some odd years, so I kind of got steeped in the value methodology early on, flying out to Omaha and Gabelli's jet every year. They were close friends, and that fund was seeded by Sandy Weil put in $25 million, Sam Zell put in $25 million, Mike Bloomberg put in $25, and a guy named Phil Frost put in $25, which was the founder of Teva, for those of you who have been around for a little while. So cut my cloth there. We had a portfolio company that preceded me coming in that was kind of beat down small cap after the great financial crisis. He said, hey, I got great news for you. You're going to become COO of a public company. And I was 31 years old or something like that. I was like, this is incredible. Bad news is you got a lot of work to do. You're going to clean up this shell. You're going to sell off all the non-core assets, which was a hardware company, a distribution company that supplied to all the Ace Hardwares, a piece of land in Pawling, New York, all these disparate assets. Sell that off, and then take the 30 million or so and buy an asset management business. So for a year, I spent going all around. I interviewed over 100 different asset management firms. I saw all the strategies under the sun, what worked, what didn't work, what was durable, what was non-durable. I looked under the kimono of the industry, and I did get a deal done. We bought a firm that had 1.6 billion under management. The stock doubled immediately, so that was just an incredible experience, and learned quite a lot about managing money. A lot of hedge fund dinners with Lee Cooperman and that whole crew, and very, very grateful for that opportunity. Went to Columbia, that doesn't mean anything anymore. Results are the name of the game. So we're predominantly concentrated long only, 8 to 12 stocks, makes up 85 to 90% of the portfolio. 10 to 15% of the portfolio we use for a derivative overlay. In English, that means we'll do long-dated options on core positions or spreads, and we also use that bucket for hedging from time to time. If we think the market is excessively overvalued, but our core positions are not at fully valued and we don't want to realize profits before full maturity, we'll use that bucket to dampen volatility, sometimes put spreads on the indices, on individual names or sectors. So that's how we do that. But I think I referenced yesterday when we were talking about BABA, it's like, yeah, the stock's up 3x off the bottom, but the options we did, we closed out at 6 to 7x. So that adds a lot of alpha, even if they're 1 and 2% positions. So that's what we like to do for clients. The philosophy of the firm comes straight from Warren Buffett, both in what we believe and what we charge. We don't charge a management fee, which is very unusual, so we get paid 0 until the account goes up, and then when the account goes up, we get a percentage of the profits based on the size of the account. And then to get paid again, we have to earn back 100% of what we were paid, which is what we call a high watermark, before we get paid again. So very few people do that. I'd love to take credit for it, but I just copied what Warren did when he was running his partnerships. And the philosophy is that great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. So how many of you were here a couple years ago when I was really pounding the table on BABA? Yeah, a few of you. So, excellent is in the eye of the beholder. Some people think excellent is some company's going to change the future, but they're losing $1 billion a year. We like to bet on sure things. At the time, Alibaba had $80 billion of cash on its balance sheet. It was generating $25 billion of free cash flow and growing, and you could not give the stock away because of all the noise about uninvestable, about China, and all of that stuff. The other thing that we do that people find pretty valuable is Hedge Fund Tips with Tom Hayes is the #1 ranked podcast in the hedge fund category by FeedSpot. You can find that on YouTube. How many of you have listened to one of my podcasts or more? Okay, a handful of you, that's great. Do you listen or watch?
Watch.
You watch it. Did you start by listening and then you switched to watching, or you always watched? Always watched. Listen or watch? Both, yeah. Listening's great because you can do other things. Watching, we go through a tremendous amount of data every single week, market data, so you'll absorb it a little bit better. I'm more of a visual learner, so you can find it on YouTube. It's definitely, if you had an idea of the people who listen to this, both in the industry and out of the industry, it would blow your mind. I'm humbled by that, and 6 years later, that's the kind of stuff that happens when you get the snowball going. We profit by buying on weakness and selling on strength. That's kind of unpopular nowadays. Buy low, sell high. Everyone knows that's the way to do it. It's like losing weight, eat less, exercise more. We all know it. None of us do it. But it's driven by deep research and the belief that the greater price dislocation reduces the risk. Where others see volatility as danger, we see it as opportunity. And the key thing here is it's not just a stock that goes down in price. It's a stock that goes down in price relative to value. So how do we define value? We tend to define value by the amount of cash the business generates, either at present or on a normalized basis. We tend to be in pretty boring, durable businesses that have been around for a very long time. So if they're having a temporary impairment of cash flow, we use our expertise to determine, is this a temporary impairment and down not for a good reason, or is it a permanent impairment and it deserves to be down and it's never coming back? And that's kind of the key distinction. It's not just buying stocks that are down, it's buying great businesses that are down for specific reasons. People ask me, do you do private deals? Do you invest in private companies? And I say, I never really do private deals because the prices that the public markets quote from time to time for some of the best businesses in the world are deals that would never be entertained in the private markets. One of the filters that we use when we go into a business, the first filter is, if JP Morgan was going to finance me to buy this entire company, they were going to give me debt financing with one catch. The catch is I had to be 100% of the equity with 100% of my net worth. So if I'm right, because the equity slug is so small, I'll make 20x if the stock doubles. If I'm wrong, I'll be applying for a job as a Walmart greeter because I'll be completely wiped out. And if I wouldn't do that deal, we will not buy one share of stock. So sometimes people think in investing business, you get paid for activity, because in the real world, many of the people that come to me are exceptionally successful people, 100, 200, 500, some 3, 4, $5 billion. And they became wealthy through massive action, right? In the real world, massive action equals massive results. In the investing world, it's the exact opposite. Massive inaction leads to massive results. Once you've underwritten the company properly and you've done your research and you're getting it at an exceptional value, the opportunities in the public markets can't be matched. The second filter that we go to with a business is if we were to go to the board of directors and offer to buy the entire company today at the price it was quoted in the public markets, would they call security to have me escorted out of the building because they think I was crazy? And if the answer is no, they would entertain the offer, we wouldn't do the deal. If the answer is yes, why would they ever consider selling at the ridiculous price it's quoted in the market? Then it's something that we want to do. And the thing about public markets that creates these opportunities is, what most people don't understand is there are structural mechanisms that force great companies to price at absurd levels from time to time, and that's the active manager syndrome. They need at the end of the quarter to show that they were in those stocks that went up the most. And frequently, those are the ones that are fully valued or nearing full value. When they have a stock that's down 20% that quarter, they tend to sell it down, and that creates additional pressure, selling pressure on the stock, that creates these aberrationally low prices because the institutions are structurally forced to get it off their books. At the end of the year, they don't want to show 5 stocks on their books that had the worst performance in the S&P 500, and yet they should be buying those potentially in December for the next year, but they don't want to put those on their books. So that creates a unique opportunity for us to take advantage of from time to time. Midterm years are the choppiest. So if you thought next year was going to be as easy as the last 3 years by buying an index fund and going to the beach, you might be mistaken, if history has any bearing on the future. This chart on the left is the S&P seasonal composite 4-year election cycle. And you can kind of see we're a little bit past where this red line is. And we've seen this kind of choppiness after the 50% plus run off the bottom in April. We've seen this choppiness. And what's interesting, this is a composite going back 98 years, and it looks exactly like what we've seen in this particular presidential cycle, which implies kind of a sideways consolidation move after a big move, with the weakness culminating around September of 2026. And you can see here the aqua is the past 10 cycles since 1985. The average returns for the S&P are 2.2%, and if you go back since 1950, the average returns are 4.6%. That's from Ryan Dietrich over at Carson, by the way. So as we move into a midterm year, political noise tends to creep into the markets, making these years the weakest of the 4-year cycle. Since 1950, they've averaged 4.6% versus 11% in other years, by the way. That's meaningful underperformance. And the past 10 cycles have been weaker at just 2.2%, with stocks usually remaining under pressure until late September. Midterm volatility pays off. Midterm years tend to see the largest intra-year pullback, and it averages 17.5%. Is anyone looking forward to a 17.5% pullback next year? No. I am actually more sanguine than most on next year, and the reason is you tend to get the average is you get a 20% correction every 3.5 years. We have had 3 20% corrections in the last 5 years. So effectively, if the long-term average means anything, we've pulled forward 10 years of 20% corrections in the last 5 years. That's why I think next year might be more modest in terms of volatility than history would suggest. But I think it would be natural to get a 10% pullback because you get one of those every 13 months on average. And it always feels like the world is ending. Midterm years are volatile, tend to deliver the largest drawdowns, averaging 17.5 compared with other years, which averaged 12.3% in the other 3 years. Yet those sell-offs have consistently been buying opportunities, with stocks never lower 1 year after the midterm low and up 31.7% on average going back to 1950. So if you have some dry powder next September and we're down 10, 15% in the general indices and you weren't in defensives that are up a lot, we're going to get to that in a second, that is generally a very good time to put money to work. And guess what? If the market's down in September and the Republicans sweep, would it be a good time to put money to work? Yes, no? No? Okay, I'm going to say yes. If we're down 10 or 15% in September and the Democrats sweep, would that be a good time to put money to work? Yes. It doesn't matter. Hate to break it to you, but I can tell we have more Democrats than Republicans in this room, which is A-okay by me. Surprising, but that's the numbers. And we're filling up pretty quick. Thanks for coming in, ladies and gentlemen. Okay, midterms favor defensive. So there's a way around this perceived and possible index pain that we're going to see. If the S&P 500 is down 10% or more at some point during the year, what stocks would you guess are getting hit worse than 10% for that to be the case? What? Big tech? Yeah, that's exactly right. Probably big tech because they have the biggest weight in the index. So midterms favor defensive stocks. Defensive stocks in this case we're going to talk about is healthcare, durable demand at a discount. And my friend Sam was saying, well, what about utilities? Utilities, the game has changed because that used to be defensives. Now it's kind of an AI trade, so it's gotten all confused. So we're just going to leave those out for right now because we can't find any bargains anyway. Consumer staples, boring works when volatility rises. And dividend payers, cash on the sidelines is coming home. The other thing that helps with dividend payers is the beginning of an easing cycle. As rates go down and people can't collect 4.5% with their eyes closed, they will be forced out on the risk curve to get that yield. And that will be found in dividend payers, 3 of which we're going to cover today. With volatility likely elevated and markets grinding sideways, we see opportunity in the neglected defensive areas of the market. Healthcare and consumer staples have consistently been top performers in midterm election years, and falling rates should pull sideline cash towards these sectors and towards dividend stocks. So here's another visual. Defensive sectors market cap weight relative to in the S&P 500 has fallen to lows not seen in over 25 years since 2000. And if you remember, 2000 was a very concentrated tech-driven market. Defensive had a very low weighting. You saw what happened next. Defensive's weighting went up dramatically as demand for them increased materially, and the Fed began easing. So defensive sectors sit at their lowest S&P weight on record and trade at valuation discounts last seen in the early 2000s, which preceded a multi-year stretch of outperformance. We expect defensives to catch a bid as volatility rises, having outperformed cyclicals by 7% in 7 of the past 8 midterm cycles leading into the elections. So 7% outperformance by defensives in a midterm election year. Is that meaningful? So if you follow the crowd, you're likely to have if history is any forecaster, underperformance and probably some pain. If you go against the crowd, right now you can't give away defensive stocks and you can't give away staples, you have a chance to do exceptionally well next year. And buying really businesses that are so durable and have been around for so long, and you can sleep like a baby at night. You don't have to predict who's going to cure cancer. You don't have to predict who's going to win the AI race. You don't have to have a crystal ball. All you have to know is people are going to brush their teeth. They're going to drink alcohol. They're going to, what else do they do? They're going to bathe themselves. They're going to shave. They're going to take their pharmaceuticals. They're going to go to the doctor. All these things that are easy, predictable, and defensible. Healthcare, what we see here in the left chart, healthcare versus S&P 500 returns by presidential cycle. You can see healthcare outperforms since 1973 by just about 9%, so that's even more than the overall basket of defensives in a midterm election year. And you can also see this visual chart, which I'll just point out. This is kind of, you are here, like when you're at the mall. Okay, that's the kind of the map. So if there's ever a year to own healthcare relative to the other 4 years in the presidential cycle, the second year of the cycle is it. Healthcare has beaten the S&P 500 in 11 of the last 13 midterm years, delivering 9.03% returns on average versus 62 basis points for the S&P 500. With record outflows, its worst 3-year relative stretch on record, multi-year low exposure and valuations at historic discounts. Healthcare stands out as one of the most attractive sectors for 2026. Volatility also sets up consumer staples. You can see in the Bank of America Fund Manager Survey, they have their lowest exposure to staples before the Great Financial Crisis, and that quickly changed once volatility picked up. Sentiment around staples is washed out, with exposure sitting about 1 standard deviation below its historical average, and the group's relative ratio to the S&P 500 at a record low, with only 5% of staples outperforming over the past 6 months, one of the weakest readings in 50 years. We think rising volatility sets the stage for a rotation. So most people say, well, healthcare is not performing anymore. I want to avoid that. We see that and we say, healthcare is not going away if there was ever a time to buy it. You know, I always joke Wall Street is the only only market in the world when they throw a clearance sale, everyone runs out of the store. I mean, you can't make this stuff up. Black Friday, they're waiting outside, tackling each other for a clearance sale on a big screen TV. Wall Street, you get a clearance sale, they run out of the building. So I suggest you run in. Dividend yield is back in play. High dividend yield, still cheap and under-owned. You can see going back to 2001, one of the best opportunities in 25 years. So when we're talking about generational buy opportunities, we're not trying to be hyperbolic. We're just dealing with the facts. Dividend payers remain neglected, with the S&P 500's dividend yield down to 1.17%, its lowest level since 2000, while nearly $7.5 trillion sits in money market funds earning 4% risk-free. As rates move lower and investors get pushed out of cash, the search for yield should put dividend and other defensive stocks back in favor. Okay, defensive pick number 1. Pfizer. Here's a stock you haven't heard of in a while. People are very, very, by the way, I had them turn up the lights before this because I knew the Pfizer name was going to put you to sleep. And that's where we like to traffic in the places that no one's paying attention to at the particular time we build our position. Is this the first time you're hearing about it? Yeah, very recently. Yeah, very, very recently. So we built our position in this iconic American blue chip as forced selling, and Pfizer-specific headaches pushed the stock to life support valuations. You can see it recently had a big flush out and then had another flush out, and we've been able to really build a nice sized position with a long-term view. Down more than 60% from its 2021 highs. The market remains fixated on the COVID hangover and patent fears, missing the rebuild in the pipeline, the deals, and the margins that we expect to drive meaningful upside. Forced selling earlier in the presentation? Forced selling is when active managers are forced to sell because the stock performance is down, and it's kind of a perpetual. It's the same thing when a stock goes up, it's almost forced buyers, or what you saw from April through basically September, you had forced buyers. People who missed the first 30% move were forced back into the market because they had sold the bottom, if you look at data, and then they had to buy the top in September, October, et cetera. Good question. Pfizer. Founded in 1849. So they've been through a couple midterm election year cycles in their day. They've been through a couple depressions, a couple great financial crises. This is a durable company. It's one of the world's largest pharmaceutical companies with a broad portfolio across vaccines, oncology, and immunology. The company markets 9 blockbuster products led by Eliquis and Prevnar, and famously delivered the top-selling COVID vaccine and leading treatment, Paxlovid, during the pandemic. $45 billion in revenues in 2025, 200 countries, 101 projects in the pipeline, 9 products with sales greater than $1 billion in 2025. CEO, Albert Bourla, I could take him or leave him, to be honest with you. But Warren Buffett taught us all, buy a business that's so great even a ham sandwich could run it, because one day a ham sandwich will run it. I'm not saying whether that's Bourla or not, but I wouldn't lose sleep if they replaced him, and I think it'll do well in spite of him. So let's just leave it at that. Pfizer reaped a massive financial windfall from its COVID franchise, generating $90 billion in supplemental revenue and $40 billion in incremental free cash flow from 2021 to 2022, pushing earnings to a record $6.58 per share. When COVID demand evaporated in 2023, revenue fell by 40%, and the company absorbed large inventory and intangible write-downs, sending adjusted EPS down 72%. To $1.84. With COVID volatility and uncertainty now largely behind Pfizer, the top line has stabilized above $62 billion, essentially back to pre-pandemic levels, plus acquisitions, and earnings have recovered toward the $3.13 expected per year. For those of you who are good with math, $25 stock, it's trading at about 8 times forward earnings. Not 80, not 200 times sales, ladies and gentlemen, 8 times earnings. Pfizer dominated the COVID era, with COVID franchise pushing revenue above $100 billion, accounting for 57% of sales in 2022. Today, COVID represents less than 14% of revenue, and the volatility has largely passed, leaving behind a stabilized business and the windfall fund to fund the company's next phase of growth and blockbuster products. Pfizer faces a late decade patent cliff, with key blockbusters like Ibrance, Eliquis, Xandi, and Prevnar losing exclusivity between 2026 and 2028, putting $17 to $18 billion of annual revenue at risk. So the stock's down. There's some reasons behind that. To offset this pressure, management has launched a cost savings plan targeting $7.2 billion in net savings in 2027 while reinvesting $500 million to strengthen R&D productivity. Management is on track to deliver $4.5 billion of savings by year-end, supporting the goal of restoring Pfizer's operating margins to their pre-pandemic high 20% range. Margin expansion is the name of the game for re-rating a stock. Re-rating just means multiple expansion, re-acceleration. Pfizer enters the patent cycles from a stronger base than peers. With no product above 12% of sales, the market is overly pessimistic and missing the $7.2 billion right-sizing effort and the pipeline and deals aimed at countering the patent pressure. Together, these offsets give Pfizer a clear and credible path to navigate the cycle and restore margins. Yeah. Yeah. Well, his stock goes down. You know, that is something we do keep an eye on. It's compensation to management. It's in line. Does he deserve that much money? It's a pretty big company, so it's kind of a rounding error. But to your point, maybe this guy doesn't. Maybe the next guy does. We'll see. After Pfizer's homegrown obesity programs flopped and the company appeared out of the race, the $10 billion Metsera acquisition provides the missing piece, a differentiated once-monthly GLP-1 platform in a rapidly growing $100 billion market. Early data is promising, with products potentially hitting the market by 2028 and delivering $5 billion plus in peak annual sales once a month versus, you know, more regular, and also oral optionality as well. If you could get an oral pill, you know, it'd change the world. The $43 billion Seagen deal added 4 approved cancer drugs and a leading ADC pipeline that Pfizer believes can grow from $2 billion in annual sales at purchase to more than $10 billion by 2030, strengthening the oncology growth engine as legacy drugs approach expiration. Pfizer's pipeline and recent deals are materially underappreciated, with Metsera's once-monthly GLP-1 platform and the $43 billion Seagen deal driving the next leg of growth. Together with Arena, Biohaven, GBT, and others, these assets should add $25 billion in 2030 revenue, offset expirations, and set up a path toward greater than $80 billion in non-COVID sales by 2030. Valuation yields set the floor. Pfizer trades at just 8 times forward earnings, a steep discount to the mid-teens industry average, making it one of the cheapest large-cap pharma names to own. The stock offers it's about a 7% dividend yield right now, more than 4 times the sector average. Its 86-year-old dividend record and 16 consecutive years of increases are supported by $15 billion in cash and $13 billion in annual free cash flow. Okay? Is this a stock where you have to lay up at night staring at the ceiling, wondering if you're going to lose all your money because they miss a quarter and they didn't win the AI race? No, this is one you can sleep like a baby. It's been around since the 1800s. They always figure it out, and they'll do that again. At 8 times earnings, Pfizer's priced for disaster with almost no positive expectations. The bar is extremely low, and we expect upside surprises as execution improves and new growth engines show through. In the meantime, investors collect almost a 7% dividend yield while they wait for what we believe could be a double over the next few years. It's my kind of story. Downside protected, upside meaningful, and lower risk. Second defensive pick is Crown Castle, which we got to move through. It's a high-quality tower REIT that we began building a position during 2024 after a rate-driven sell-off cut the stock by more than half. The unwind in rate-sensitive equities left Crown Castle at levels we view as overdone, and we see it as a clean, levered way to play the rate cycle and capital rotation back toward income as yields move lower. So this is a dividend payer. It's the leading pure-play U.S. tower company with 40,000 wireless towers nationwide. It leases space on its towers to the big 3 carriers, which make up 75% of revenue, creating durable demand and recurring revenue that have made towers one of the most attractive business models in the communications infrastructure. Strong mobile data growth, along with rising AI-driven network needs, leads us to expect 5% organic same tower revenue growth over our forecast period. With low capital requirements and massive operating leverage, much of that growth should flow to the bottom line and support long-term compounding. So they got rid of the fiber business, which was kind of a drag on investment. And the second thing that they did was just a couple of things on mobile data. Demand has grown by more than 30% annually for the past 3 years. Most people wouldn't guess that. And is projected to compound at 15% through 2030. This sustained growth requires ongoing carrier investment to support higher traffic And with 5G still in its early 20-year cycle, long-run demand for tower infrastructure remains strong. So Crown Castle's removed the two biggest overhangs, divesting the value-destructive fiber segment and placing proven industry veteran Chris Hildebrand in the CEO role, which we view as a key catalyst to the turnaround. Together, these moves create a higher margin, pure play tower operator that can return capital to shareholders on a massive scale through buybacks, through dividends, et cetera. They invested $19 billion into the fiber with poor returns. They sold the segment for $8.5 billion. They will use the proceeds to delever the balance sheet and fund buybacks, making CCI a leaner, higher margin tower company with a very nice dividend. Leadership had been a revolving door. Hildebrand is an industry veteran with more than 3 decades of telecom experience. Rate relief ahead. Like all REITs, CCI trades on interest rates, and the 348 basis points rise in the 10-year from late 2021 to 2023 drove a nearly 60% drawdown in the stock. Falling yields will unlock cheaper financing, lower interest rate burden for companies like CCI, which carries $24 billion in net debt and nearly $1 billion in annual interest expense. While the dividend remains neglected today, we expect CCI's 4.5% yield with total shareholder yield above 6% to become far more attractive as rates move lower and sideline capital is pushed back into yield. CCI is a pure play on the rate easing cycle, with lower rates cutting interest costs, improving refinancing terms, strengthening tenant activity, and drawing investors back to dividend payers. With total shareholder yield above 6% and a 50% price upside by our estimates, CCI stands out as a high-quality name in a volatile midterm year. By the way, as always, this is all opinion, not advice. Consult with your psychic before doing anything. Yes? Yeah.
A lot of the speakers this week have been talking about how even if the Fed reduces to a steepening curve, it may not affect the 10-year.
Yeah.
What are your thoughts if that doesn't? What if the 10-year doesn't go down?
I think there are another a lot. That's consensus right now. I think there are a lot of other factors at play. You have Besson has some programs to work on the 10-year yield explicitly. Some programs that they're doing in terms of what they buy, where they sell along the curve. Stablecoin demand is going to add an additional meaningful amount of demand for treasuries. You can count on this administration getting rates down one way or another. And Hassett, he's a complete inline. Let's just put it mildly in line with the ideas coming from the top as to where interest rates should be. Inflation be damned. They're going to bring rates down. That's what's going to happen. And at the long end, they can manage the curve by where they issue and what they buy in. We stopped quantitative tightening in December. That usually precedes the recurrence of quantitative easing. I'm not saying that we're going into quantitative easing, but I am saying there have been programs in the past that would be considered Operation Twist and the like, which a few of us with a couple of gray hairs remember. So I'm much more sanguine about rates because unlocking the housing market is dependent upon that, and that is priority number one in the administration. So I would keep that in mind. And finally, defensive pick number 3 is Hormel Foods. Started building this position 2024 after rising input costs and poor execution pushed the stock to multi-year lows. We've added on further weakness as this self-help story is priced like it's going out of business. With protein demand for GLP-1s trends as tailwinds, we see meaningful upside from here. Founded in 1891, something called the Lindy effect. Does anyone know what the Lindy effect is? The longer something has been in existence, the higher likelihood it's to stay in existence for an equivalent amount of time. Google it or whatever, ChatGPT it, Grok it. Founded a global branded food company with $12 billion in revenue across 80 countries and leading brands like Planters, Skippy, Spam, Genio, and Applegate. The company holds the number 1 and number 2 share positions in more than 40 categories, with retail making up about 2/3 of the sales. Food service 30%, and international the rest. So, since 1891, how many depressions, how many recessions, how many great financial crises this business has endured and it will continue to. Hormel is a dividend aristocrat, having paid an uninterrupted quarterly dividend since 1928. They didn't even cut the dividend during the Great Depression. Never met in the Great Financial Crisis. Oh, and by the way, they not only paid it, they raised it for 60 straight years, which makes it a dividend aristocrat. Today's yield is above 5%, the highest in decades, with average net leverage at 1.5% and a payout ratio just under 80%. We view the dividend as highly secured with room for continued growth over time. Hormel's heavy exposure to perishable inputs, 72% of 2024 sales, has driven major commodity pressure with last quarter's beef near record highs, pork bellies up 30%, and wholesale pork up 10%, resulting in a 400 basis points margin hit. Relief now appears underway as key input costs roll over and tariffs on 200 plus food products are rolled back. If you look at the chart of hogs, if you start to look at feeder cattle and live cattle, they are rolling over. And when commodities turn, it's not like a modest pullback, it's like they collapse. And when they collapse, the margin of Hormel doubles and triples. It's a big, big factor. Hormel is in the early innings of a margin recovery as input costs ease, pricing actions catch up, and the T&M initiative drives meaningful cost savings. With recent operational hiccups fading and efficiency gains taking hold, we see a clear path back toward mid-cycle 10% plus margins over the next few years. Hormel is entering a new phase of growth supported by durable customer shifts toward lean, high-protein eating, a core competitive advantage for Hormel. With a decade-low valuation, a clear path to 2 to 3% annual sales growth and margin recovery underway, we see the setup as highly attractive with material upside in a bumpy midterm year. So this is how you contact me. As I said, the podcast on YouTube, Hedge Fund Tips with Tom Hayes, or anywhere you get your podcast, Twitter, @HedgeFundTips. Our website is hedgefundtips.com if you want to contact us. And there's my email and phone number. We have exactly 2 minutes for questions. So if anyone has any, speak now or forever hold your peace. $1 million and no lockup, quarterly liquidity, full transparency. We run it as separately managed accounts through Interactive Brokers. So you own the account. You can technically log in every day and see what's in your account. Full transparency, full liquidity, no lockup. Great Hill Capital is the management company. It's an LLC. No, there's no pass-through because you own the account, whether it's in your name or in your IRA or in a corporation or trust. You'll set it up with Interactive Brokers. All we do is manage it. We have investing privileges only. If you want to take money out, you just log into your account and take money out. Yeah.
And what is your fee on like $1 million portfolio? Are you invested in 1,000 stocks or?
No, we run a concentrated portfolio of 8 to 12 stocks. That makes up 85 to 90% of the portfolio. 10% is a derivative overlay for excess returns on the core positions and also hedging to dampen volatility when we think the market's overvalued. The performance fee ranges from 25% down to 15% depending on the size of the account. And then there's also something we call a high watermark. So not only do we not get paid until your account goes up, we don't get paid again until we earn back 100% of what we got paid. It's, I set it up that way. One, I copied Buffett when he was running his partnerships, and two, it's the only deal that I would accept on the other side of the table. I wouldn't want people getting paid whether my account went up or down. I want them getting paid when it goes up. So, yeah. What's that?
How often do you get paid?
Well, the Interactive Brokers looks at it quarterly, and it just looks back infinite quarters to see what is the highest level that the account has ever closed at. And if it's above the highest level the account has ever closed at, it's the split, whether it's 80-20 to the client or less or more, depending on the size of the account.
And you would get paid via a separate payment outside the account?
No, it's done within the account. Yeah.
It's a retirement account.
Yeah, correct.
How would you get it?
It's automatically done by Interactive Brokers. Yeah. So we can discuss that on Friday when we talk. Yeah, go ahead.
Do you ever contemplate doing an ETF or just doesn't lend to your model?
No, because you can't really do derivatives right. And the reason we run in separate, this is a key point. I'm glad you brought it up. The reason we run in separately managed accounts versus a commingled fund is because we want to put new clients in those stocks that we believe are just leaving the station versus the stocks that are up 50, 60, 70% in the last 6 or 12 months. So we, because if we put them in the ones, like in a commingled fund, you're forced into everything that's already gone up a lot. Whereas with separately managed accounts, I can put them in the 8 or 12 that I think are just getting ready to take off. And that has a huge impact on IRR because, I could put them in Alibaba at 160 when everyone else has a $70 or $80 basis. But the move from 70 to 160, as it goes from 160 to 320, the IRR is not as aggressive versus if they had that low basis. So that's not one that we would aggressively put a brand new one in because it's already made half of its move. We want to put them in the Hormels of the world and the things that are just getting going. Yeah. Yeah.
What is your minimum investment in your company?
It's $1 million. 1 million. Yeah. 1 million for individuals, 5 million for family offices, 10 million for institutions.
I've looked at some of your picks, and as turnarounds, they tend to have higher debt levels than.
It depends. Some of them do, some of them don't. Baba had no net debt. But the first thing we do, as we covered yesterday, is we deal with solvency risk. We look at the balance sheet first because if it's down a lot, there's a reason. The market's afraid of certain things. And then once we get comfortable with free cash flow relative to interest, debt service, and the trajectory of the turnaround, then we can feel comfortable going into it. Yeah. And that debt, you got to understand, it's secured by assets too. The towers, it's like someone looks at a REIT, like look at all the debt, but look at all the real estate that's the over coverage of that debt relative to the underlying assets. So in terms of like REITs, it can be misleading. Yeah. Was there one more question? Yeah.
Both taxable and non-taxable?
Yeah, we do both. Yeah. Our average holding period is 3 years. So even for taxable accounts, you're dealing with long-term capital gains for the most part. We don't like to sell stuff. Yeah.